We're often reminded of Shakespeare's quote, "What's past is prologue," and so the continuation kind of tends to continue some of the same themes, especially this year when we talk about kind of the volatility, the spikes, and then you look at the drawdown that we had in the middle of the year. It kind of leads to like a resurgence and so forth, and so you get some of the same stories. But I think really the four themes that I kind of see in the 2025, and we talk about a lot in the CIO office is, the consumer side being two-thirds of the economy is very robust, but it's K-shaped. We talk about this a lot, is that the top 20%, top 40% are doing okay to great. But the bottom 60% are struggling. And you tend to see that kind of be Darwinistic in some of the purchases. Although I just saw a report today that the online discount is running at 33%, and that's the lowest it's been in the last like 8 years. It started out at 42%, at COVID was 40%, and it's been dropping down. Last 2 years was 35%. So now we're at 33%. You don't lower the discounts like they have if you're not seeing robust sales. And we're seeing that across the board. So you're seeing a little bit more increase in some of the spending, even though the sentiment numbers don't really speak to it. But the consumer, from a balance sheet and a standpoint of net wealth, is actually doing well on a macro side of it. And since that drives about 50%, the top 10, 15% drive 50% of the earnings or the consumption, that leads to positive earnings for select companies. And so I think that K-shape kind of creates a surge upwards, but maybe is still anchored or tethered a little bit by the bottom 60% that's struggling on that side. Earnings per share, which I know Jake will go into great detail, but we had a really good year this year in earnings. You saw an uptick from in the second half from the first half. We were just kind of showing some charts today about being a prisoner of the moment, how people kind of feed into what the sentiment is at that time. And so you're seeing an uptick in expectations, but earnings per share expected about 14.2% in 26, and another 14% projected in 27, which is a long ways away, and would expect that to kind of, if it follows similar patterns, maybe trace back a bit. But if that's the case, then you're seeing positive momentum for the companies. You are seeing insider buying at elevated levels. And on top of that, and even though it's contextually, it should make sense, but the insider selling hasn't. So even though we're close to all-time highs and so forth, you're not seeing a lot of insider selling. And I think that goes into the corporate profit margins, which are about 18.7% to be projected. That's relatively high. And if I go back to Warren Buffett in 1999 saying that corporate profits as a percentage of GDP, if you think it's going to be above 6%, you're fooling yourself. Well, we've been averaging about 10 to 12% here in the last 15 years. So you're seeing a big change in how they're maintaining and protecting profit margins on that side of it. So I think those are kind of the areas that we're looking in. A slightly accommodative Fed. We don't think the interest rates are going to drop precipitously. It's going to be kind of worked a little bit by the 10-year and 30-year by being anchored with some elevated inflation, although we got a good CPI print here recently. But those four areas kind of give us a boost to what we think in the marketplace. But it is a midterm election year, so we do think that is be a little bit pragmatic on that side, because that's when you have your usually lower returns and biggest drawdowns. But those are the four areas that we're a little more optimistic about.
Yeah, and I would just add to what Matt said, themes that do connect to directly to what Matt said, but I termed it 2025 the three T's and an A. We had impacting the markets. We had Trump, the disruptor in chief, right? The big T, the first T, hard, very hard policy pivots, almost diametrically opposite of the previous administration in many ways, immigration being a good example. So that created a lot of uncertainty in the market. And the second T was the tariffs. And as Matt points out, that's when we had the big drawdown in the market, right? We round tripped it. And it seems like it's pretty far in the rearview mirror because it didn't last very long. But obviously that was a big one. And the tariff, we still haven't seen the impacts of the tariffs bleed through, in our opinion, in terms of potential for sticky inflation. Tax relief, third T. A lot of what went on is what's the cost of that tariff and tax on that. And that was sterilized by the one big beautiful bill, which obviously created the impetus for I think the run up here to the end here Santa Claus rally, and another amazing year for the markets, both stocks and bonds. That's, rare actually when both produce the types of returns that we saw this year, 17% plus on the S&P, 7% on bonds, right? So, but I think a lot of those influence, and the A, I forgot the A. I think that one's obvious if anyone wants to guess. The AI bazooka, 350 billion. That's a 1% pop in GDP right there. So when you look at 26, I would say, we were cautiously optimistic as we were last year, because we still got the tax relief kicking in a big way. However, and that's obviously a positive thing for carrying the economy. But then we have sticky inflation. We diverge still a little bit from the market here, that we think inflation is going to be kind of stuck in that 275, maybe higher range, for a host of reasons. But I think then that plays on to the actual rates will head, where the Fed, will be putting rates next year. Trump may pack the Fed, but that may not work out well in the end in a positive economy on the long end of the market, right? And we saw a little bit of that this year. Rates are down, but the front end a lot more than the back end. I think we've seen the rate, most of the rate relief is in the rearview mirror, and that's okay. This is a decent yield curve construction as long as it's stable. So I think those are kind of the influences. The AI machine is going to be a bazooka again this year. However, the market is beginning to question the circularity and the time and the degree of payoff on this AI trade. I think that'll continue to be tested and questioned this year. So I think a little bit more volatility, but I think, cautiously optimistic on where more markets will head in 2026.